Happy Monday. Welcome to the show. This is Chart This with Dave Keller, and I'm your host, Dave Keller, coming to you from a beautifully overcast but comfortable Redmond, Washington. Thanks for joining me every weekday after the close as we break down the market action using the best practices of technical analysis and behavioral finance. The technical toolkit is designed to help you appreciate the message of the markets, the message the markets provide back to us in the form of price action and derivatives of that in terms of breadth and sentiment and all those other sorts of data points. And I would argue in an environment like this, where the market continues to push higher, whether or not you think that's the right move or whether you think that is justified based on whatever fundamental or macroeconomic lens you're choosing to view it on, market's going higher. And if there's one thing that I learned over a career of a lot of bull and bear cycles, is that the most bullish thing that the market can do is go up, right? As long as we keep making higher highs and higher lows, conditions are strong. As long as we keep making higher lows when we pull back, the market is in a bullish framework. And so that's why today, with the S&P making yet another new all-time closing high, I'm reminded of that message of the markets. By the way, just a quick announcement. I will be doing a free webcast tomorrow on Tuesday the 15th, 1 p.m. Eastern, 10 a.m. Pacific, called Election 2024, Positioning Your Portfolio. We'll talk a little bit about the time between now and election day to year end, what types of stocks, what types of positions could make sense given different outcomes to the election, and which things may actually thrive in either outcome. So make sure you sign up for that. I'd love for you to join me tomorrow. You can go to marketmisbehavior.com/election2024, election 2024, to sign up for that free event. Looking at the markets here, obviously continued upside, right? The market kind of going onward and ever upward, as I like to say. And today, sort of more of the same. This week, I would say the big difference between this week and prior weeks when we've talked about the market going higher, it's been a lot of macro drivers, right? Inflation data, jobs data, Fed meetings, something like that. For the next couple of weeks, we will have some economic data for sure, but it's really all about earnings, right? Starting tomorrow, you have quite a bit of earnings coming in. Friday, we kicked earnings season off essentially with some of the banks like Wells Fargo, JP Morgan having a nice beat and popping to the upside. Starting tomorrow, we have a lot more banks, some healthcare names, Netflix later this week. A good chunk of the S&P 500 will be reporting this week. Most of the S&P 500 will be reporting in the next 3 weeks. Why this is so meaningful is it's because it gives us a sense of how companies are pricing in these potential outcomes, right? The market is pricing in a soft landing, that the Fed's actions to date have been well received, and that they will be able to continue to navigate this, bringing inflation down, keeping job growth steady, and kind of doing this Goldilocks thing. Are companies also kind of pricing this into their own models? Now, the kicker is, with earnings season, estimates have come down quite a bit. So we'll see if companies are able to beat their, arguably the much lower bar as estimates have come down. However, I think the market would see earnings beats as a pretty big win. So a lot of hopefully granular data we can get from a bunch of earnings calls over the next couple of weeks. Let's focus on what the market did today. The S&P new all-time high. So ring that bell. The S&P closing just below 5860. For the first time in history. That's up 0.8% from Friday's close. The NASDAQ composite up slightly higher, up 0.9%. The Dow was up 0.5%. It's kind of everything just sort of working here. Mid caps and small caps both up about 0.6%. So large caps outperform mids and smalls, but they're all doing just fine today. Only red on that front page is the VIX, which did go just slightly below 20. If you remember from frequent messaging on the show here, VIX 20 is kind of that basic level for me. When the VIX is above 20, I've learned to be much more cautious, to be wary of potential downside risk, given the fact that volatility is elevated. When the VIX is below 20, that's more of a low volatility environment, usually consistent with the bull market phase. So remaining below 20 here as we get into the meat of the month of October, pretty bullish, right? And I would say a VIX above 20 could be a danger sign if we would see it. Not seeing it yet. As a reminder, I can see comments if you're watching on Facebook, on LinkedIn, on YouTube, on X. I appreciate so much you tuning in live. If you are, drop a question in the comment section of whatever platform you're in. I can see all of those. I'll hope to take a question or two at the end of the show. Anything I don't get to, We put it in the final bar mailbag. If you missed Friday's show, with some really thoughtful questions about a number of different technical analysis and other concepts. Bond markets were closed today because of the Columbus Day holiday. They still remain closed on this particular Monday. So no change to interest rates. The reading you're getting is essentially from, Friday, and then we'll update it really on Tuesday. So bonds, not much to talk about here today. We'll probably get more color tomorrow as the bond markets reopen. Looking at the commodity space, all in the red here. Gold down slightly, silver down a little bit more. Copper, crude oil, natural gas, that's where we're seeing some major downticks. Crude oil prices, as referenced here by the USO, which is a bullish crude oil ETF, down about 2% today. Looking at the crypto space, we can see quite a bit of green, actually. Bitcoin actually resuming its uptrend, kind of, choppy, bouncing off of 60K going into today's equity trading session. But once equities opened, pushed to the upside pretty nicely. Bitcoin currently trading right around 65,800. Ether prices just above 2,600. Both of those are up, decent bit from the end of the sort of 24-hour trading day on Sunday. So crypto is sort of resuming a bit of the uptrend, and a lot of those charts are not, are sort of like in wait and see mode, I would argue, but some of them really on a day like today, shining quite a bit. Very interesting to note on the sector returns list. This is just for today, of course. The utility sector, it looks like just barely edging out technology. We'll see as the closing data is all kind of wrapped up and the page like this is updated formally for the official close, if that holds. But for now, it looks like utilities and technology essentially tied for first place, both up about 1.3%. So you have one of the juiciest offense sectors and one of the most, sort of lighter, defensive sectors, although utilities has been a bit of a growth play in 2024 in a lot of ways. REITs, number 3, though, up 0.7%, it looks like. Energy, the only S&P sector in the red, and not by much, 0.2%. You do see in some of the energy stocks, if you look at the stocks in the S&P that are down today, you'll notice some energy in there. I think like Diamondback I picked up was one of the worst performers in the S&P. But again, most things actually had a pretty decent day today. Consumer staples, consumer discretionary, second and third from the bottom on today's session. We didn't do a live show on Friday. We did an all mailbag edition, and I updated my market misbehavior premium members over the weekend, reiterated that our market trend model remains bullish on those 3 timeframes: short-term, medium-term, long-term. And again, when my market trend model is bullish on all those timeframes, that tells me to be optimistic. That tells me to remain engaged with long trades as long as the charts continue to support the uptrend. But assume that trends, particularly bullish trends, are innocent until proven guilty. Looking for some red on the short-term model would be the initial warning sign that things are maybe starting to slow down a bit. We have seen that a couple times so far in 2024 on the brief pullbacks that we've experienced. Again, not much of a drawdown in the average day. It's a very 2021 kind of feel to this market, where it's like big, consistent uptrend. Minimal drawdowns. I mean, 3 to 5% is a huge pullback in this kind of environment. Things continuing to go higher. Noting semiconductors, also home builders at the top of the list in terms of today's gainers of the Dow industry groups. And as we look at the Magnificent Seven and Friends, sort of a list of leading growth names, you can see NVIDIA up 2.4%, new all-time high for NVIDIA. We do have that chart as part of our chart list to review here in a few moments. Apple, Alphabet, both getting it done as well, up over 1% today. The only 2 of these in the red today: Amazon down slightly, 0.7%, Netflix down 1.4%. And that is an interesting one because Netflix is the only one of this bucket reporting earnings this week. I think they're on Thursday, if memory serves me correct. I think Netflix is on Thursday. It's the only one of the Magnificent Seven names in the red. All right, let's go to some of the charts as a reminder. I appreciate the comments that I'm seeing so far. If you do have questions as they come up during the review, pop them in there. And at the end, I'll try to take a question or two before we wrap today's broadcast. Looking at the charts, the S&P going onward and ever upward, a new all-time closing high for the S&P 500, just barely, missing 5860 for the first time. 6,000 seemed like an absolutely ridiculous upside target in the S&P 500 because at the end of last year, which is when a lot of times you're kind of minting these projections. The S&P is down around 4,800. And here we are 1,200 points higher almost in 9 months, which is just a crazy resilient uptrend. Given all the uncertainty going into this year, would not be my general back of the envelope expectation for the S&P. But that's the beauty of charts like this, right? You're not paid on your ability to guess where the S&P is going to be on a future date, although we love to do stuff like that. It's more about recognizing the trend. And I would think if you think of technical analysis and chart analysis as less trying to predict the future with some magical crystal ball and more just looking at the evidence and following trends, a year like this reminds you there's plenty of money to be made just following trends that are working. And you see that on a chart of the S&P. You see that on individual stocks like a Palantir or others that have been these nice, consistent uptrends. They're out there. Make your process about identifying those trends and following them. And I think you'll be well served in a year like this. The S&P momentum wise, by the way, really improving. And I think that's, when you think about what did we learn from mid-September to mid-October that tells you that this market is in a position of strength. I would say the momentum remaining quite strong is probably one of the most important factors that I would see. The fact that the RSI popped above 50 second week in September and has remained above there that whole time, even in this brief pullback, if you can even call it that, first week in October, end of September, the RSI didn't even get down to 50. I mean, it's just remaining very strong momentum. Now, when you have such strong momentum, when you have a strong uptrend, the contrarian in you, if you have that part of your brain, is going to be screaming overextended. It's going to be screaming that this market has gone too far. It's going to be screaming that we probably have to pull back a little bit. I would just remind you, even when the S&P 500 becomes overbought, just look on this chart. The first time in a cycle when the S&P becomes overbought, right? I mean, look back here in November of 23. Look here in June of 24. When the market becomes overbought, after not being overbought for a while, that's usually not a great time to sell, because what that tells you is there's an influx of buyers. There's an influx in buying power pushing things to the upside. The market will top at some point. I guarantee it, but not today, right? And that's the evidence that you're seeing here. Remember that uptrends can persist much longer than you'd expect. That's why when the market's in an uptrend, I go with the line in the sand approach. I don't put it on myself to decide whether or not the market is going to go further. I'm going to assume that market is going to go further to infinity, although I know that's not actually going to happen. I assume that we're going to persist until the evidence tells me we're not. And that's why trend lines are very important. That's why lines in the sand and support levels are super helpful. As long as we keep making new highs, keep bumping up your stop, keep your trend lines updated. At some point, those levels will be broken. That's when the market is topping, not today. Nice update for the S&P. As I mentioned, the market trend model now bullish for the last 5 straight weeks as of last Friday. As we open trading here this week, of course, we're making new highs. So for me, the market trends on all the time frames that I'm interested in, short term being a couple weeks, medium term being a couple months, long term being a couple years. I mean, that's a generalization. Tells me conditions are pretty good. Until that short-term model turns negative, at least in this particular chart, things are actually quite strong and getting stronger. The new Dow theory is something that we highlighted at the end of August as a potential bearish signal, because we had a non-confirmation where the S&P was making a new high at the end of August and the NASDAQ 100 was making a lower peak. And I've identified that area with the green and the red trend lines above the price series. If you look to the right, though, what's happened in the 6 weeks since the end of August, both of them have continued to make new highs. The S&P, equal-weighted S&P, by the way, has made new highs all through September and now into October. The equal-weighted NASDAQ had not done so until today. We're finally making a new 52-week high on the equal-weighted NASDAQ 100. So a measure like that did look a bit concerning has corrected itself. And that's also the sign of a market that is resilient, that is continuing to push higher. Signs of a warning, right? Those red flags, instead of being confirmed with a breakdown, are invalidated by a breakout. And that's what I think we're seeing here in October. Seeing a lot more new highs. Not all of these data series are updated for today, by the way. This is the S&P, the difference between net new highs versus new lows on the NYSE. This is new highs in green, new lows in red, 52-week highs and lows, that is. And in the bottom, same reading for the S&P 500. On Friday's close, about 14% of the S&P made a new 52-week high. Given what I saw today, given what I saw with the breadth data today with the advanced decline line, excuse me, I would anticipate that these both go quite a bit higher. And what that does, excuse me, is it changes the trend that we've observed in these breadth indicators, right? From mid-September to early October, we have the market going higher on less and less new highs. And that can be a concerning development because it tells you that even though the market is trending higher, less and less individual stocks are participating in that uptrend. But Friday and now today, most likely with stronger readings, starting to reverse out a little bit. And as we talked about, as new highs were lessening, if you see an influx of new highs, that's usually a sign of emerging strength, and that tells you we could be going a bit higher as long as we see new 52-week highs. Here's the VIX, by the way, which did pop above 20. This was earlier this month in October, that is, and we highlighted how that could be a potential a sign of a further correction, given the fact that you rarely, if ever, have a correction without the VIX going above 20. That's sort of the level, the differentiator between a low volatility and high volatility environment. Today, with today's rally and the volatility coming down, the VIX now over the last couple of sessions has gone from almost 23 to now below 20. So if we continue to go higher on lower volatility, this is a bull configuration, right? And overall, fairly constructive. I did a show earlier today for Stock Charts TV where I've put a lot of content over the years. I'm doing a weekly show every Monday. I hope you can check that out. Excuse me. I think that should be posted here, if not now, very soon. Talked a little bit about sentiment indicators. We on this show talked about the name exposure index and the AAII survey, I think on Thursday of last week, as those data points were updated. Here we're looking at the third market sentiment indicator that I wanted to highlight, which is the equity only put call ratio. When this reading is high, that means a lot more puts than calls, kind of a bearish bet, which often happens at market lows. When the put call ratio gets very low, that means a lot more on the call side, which means investors are overly optimistic. If you look at the raw data, now this is updated as of Friday's close. I don't have today's reading just yet, but the gray data that you see in the background is the raw data point. If you look, actually one of the lowest readings we've had over the last couple of years. Last time we were this low was at July of 2023. I have the 5-day average in pink just to kind of smooth it out a little bit. That's what conditions looked like kind of in the middle of July, just before the major peak at the end of July of 2023. So when you have an extended rally, one of the warning signs you look for are overheated signs or signs of euphoria, excuse me, from sentiment indicators like the put call ratio. And I think you're kind of seeing that here today. Sorry, I'm dying here, guys. Excuse me. So overall, what does that mean? I think the extreme low put call ratio is a bit of a concern. It's really concerning, though, if you see the rotation higher. That's what I think you saw here at the end of July, which is a bit of a change from a put call ratio trending lower. It's all of a sudden a put call ratio starting to pop higher. So look for any sort of upside tick there. But the fact that we're very, very extremely low is a bit of a red flag. Other sentiment readings, though, not overheated just yet. All right, to finish off here, let's talk about semiconductors. We can see the SMH making a new swing high. NVDA, which is my next chart, I believe, making a new all-time high. So when the juice, when the semiconductor is sort of a bellwether group, are in a primary uptrend, when they're making higher highs and higher lows, when they're facing resistance like 250 and breaking it, that is a bullish development. This last week, we've seen the SMH break above resistance. We're seeing the momentum improve with the RSI pushing above 60. That's a nice follow through to the upside. And NVIDIA, here we are making a new closing high on an intraday basis. We're kind of right up to that peak from mid-June, but on a closing basis, this is a new peak for NVIDIA. Overbought today, and hasn't been overbought actually since June of this year, back at that previous peak. Becoming overbought, though, as a reminder, I mean, anytime I see someone say, oh, it's overbought, does that mean we're done? No, the last two times we were not overbought for a while and then popped up. We're right here in late May, which was there, and in January, which was here. Two arguably fantastic times to buy because that influx of buyers or buying power, right? That the uptrend, the strength, the breakout above resistance on improved momentum is usually a bullish sign, particularly for the medium term. So most likely this is probably not the end, but maybe more the beginning. Now, what would be different and what you have to remember is in both of these situations, we actually broke above that overbought reading and remained overbought for quite some time. So every day, NVIDIA remains overbought. It's a bit counterintuitive, but that's actually more of a bullish sign because that tells you that the strength is pretty meaningful. And if we would, tag the 70 line and then come down, that would be a sign of a tactical pullback. For now, I would read this as more constructive than anything. Here's Home Depot, which to be honest with you, I have Home Depot. A lot of people have mentioned, why do you have Home Depot? It's funny. I don't know if it's that funny of a story, but the reality is, from doing a lot of presentations, I would always need an example stock to highlight just different technical indicators or different fundamental, valuations. And so I had to pick a random company years and years ago, the one that I would just have up. And so when I have Home Depot, that's like a placeholder of the place I'm going to look at a chart. So don't think I am always looking at Home Depot. That's like my standard operating procedures. I have the markets on one tab, and then I have Home Depot, and that usually changes. I'm bringing up different charts. I go to that tab and start bringing up a bunch of different things. Having said that, today I actually am talking about Home Depot because we talked about with NVIDIA how it had become overbought and what you might look for. And on Friday, Home Depot actually did come down below that overbought region. Today, though, back right above it. And so you really didn't get a topping confirmation on Friday's session. Today, we're actually negating that. It looks like we're back up to that overbought region. So home builders, home improvement stores, all doing quite well. I mentioned home builders, one of the top groups using the Dow industry groups today. We're seeing strength there. That's definitely in a lot of ways a play on rates coming down because homes are a little less expensive or at least a little more accessible. You anticipate some people doing improvements and upgrading and things like that. And the charts are certainly reflecting that optimism for the housing space. Banks big in terms of earnings this week. Earnings season really kicking off here. And just as a quick preview, I mean, other things coming up. Let's see. Friday we had JP Morgan, Wells Fargo, BlackRock, Bank of New York, some of those. Starting tomorrow, Goldman, Citigroup, Schwab, PNC, State Street. These are all tomorrow. Other things to keep in mind would be airlines like UAL reporting tomorrow as well. And then we get into some other sectors as well. And through the course of this week, we've got some railroads, we've got some materials like steel companies, a lot more financials, some healthcare. So quite a few. So this is a really good time, by the way, if you have a portfolio with individual stocks. Always keep in mind when that next earnings date is going to be, if for nothing else, to recognize there's going to be a lot of volatility, and that's what that's going to be related to. Banks that reported on Friday overall did quite well. You can see Wells Fargo gapping higher on Friday, today further upside. And that's, I think, very, very important. When you have the gap like you do on Friday, what I will always tell you is when you have a gap, that happened, right? That's now printed, but what's next, right? After you have that big gap on Friday, we have all weekend to kind of, sleep on this information that Wells Fargo had a good quarter. Do you see additional buyers coming in willing to pay even more than that gapped up, now elevated valuation that just happened overnight on Friday? And the answer is, yeah, we actually made a new all-time high, closing above that May peak today, traded down a little bit and sort of finished in the middle of the day. But overall, I still see this as a nice upside follow through. I'd say so far, financials beating, lowered expectations, the market giving it a big thumbs up. Mentioned airlines like United Airlines, Delta was last Thursday, if I remember right. Certainly late last week, had a nice quarter, had a nice bounce. You're seeing further follow through from the airlines today. UAL is reporting through the course of this week also, but for now, making a new high. And airlines are one of those areas that have really started to improve. UAL, for example, making a pretty significant low in early August, and then just this nice consistent uptrend with minimal drawdowns. The real, I think, exciting time is when we break above previous resistance, showing that there's more optimism than there was before. It's kind of where I'm at with things. It's probably one of the more constructive chart this episodes we've had, because on a day like today, I'm not seeing a lot of negative reversal signs. I'm not seeing a lot of distribution signs. I'm seeing a lot more accumulation. I'm seeing, indicators that had been kind of questionable in September now resolving to the upside. For now, I'm seeing continued upside until proven otherwise. Let's take a question or two, and then we will wrap the show for the day. And I appreciate you guys so much watching wherever you're at, and if you're watching it on delay as a recording, thanks for tuning in as well. Tony asks, your CMF volume video was especially useful. Yeah, that was on. Oh man, it's a blur. I think that was Friday's video on my channel. I did a bit of a deep dive into Chaikin money flow. You know, I don't talk a lot about volume on the show, and that's because volume, to be honest with you, has not been a significant part of my process. But I do use some volume based indicators, and one that I found very helpful is Chaikin money flow. And if you look at that chart, I'd encourage you to check out the video. We looked at what has happened to the volume trend going into major peaks, and you're not seeing that warning sign just yet. That's one of the other things. As I'm going through all the evidence over the weekend, I'm seeing a lot more to like than not to like, which is tough for me, to be honest with you, because I am programmed to be a contrarian. I'm always looking for sell signals or signs of distribution in an uptrend. But for now, I'm not seeing it. I'm seeing quite a bit of consistent up move. Not a lot of crazy questions, but I will answer one more. When will we see red in the market? And I love the simplicity of your question. I appreciate it. I will tell you. So when we will see red in the market is when buyers are exhausted, and that is the very simple answer, right? When the market is done going up, that's where you start to see red. You know, I don't actually include this upper boundary. I'm thinking on the chart that I showed earlier, now that I'm thinking about it. But, you know, we talked about this as the line in the sand, kind of this trend line off of the lows. But you can also see we have this trend line tracking the highs. And as of today, really Friday, we kind of traded up to that trend line resistance. Today, we're actually pushing above it. So the answer is not today. Here's the thing, though. What you have to remember is in a bearish market, when the market's going down, that's when you will often see some of the biggest up moves, right? Because there are counter trend bounces, what we call a dead cat bounce. The market moves lower, then you have this big spike higher. And a lot of people get sucked in because it's a big up day. And I have to remind them, look, we're still in a bearish trend overall, but that was a nice bounce, with some buyers coming in. The opposite is also true. You can have some big down days even within an uptrend. And that's why indicators like Chaikin money flow can be really helpful, because they're actually measuring the volume on those pullbacks. And even if the market's still going higher, if you have these big, pushes lower on heavier volume, that can actually happen when the trend is still positive. But that volume change can tell you that maybe there's a lot of people selling into strength. Right now, I get the sense more it's buying into strength, right? You see additional momentum to the upside. When you see people selling into strength, you start to get bearish divergences. You start to get breadth rotate lower. You start to see volume-based indicators rotate lower. I'm not seeing that yet, but those are the things I will absolutely be monitoring through the rest of October 2024 and probably beyond. Folks, that's it for the day here. I want to thank you guys so much for joining me every weekday after the close for our show. Thanks so much for asking some thoughtful questions. Please keep your questions coming. If you're watching this later on a replay, just please make sure that you put your questions in the comments. I'll put any questions I don't get to in the mailbag, and we'll do a mailbag episode probably later this week. For Market Misbehavior, I'm Dave Keller. Two things. Number one, go Guardians, beat the Yankees. And number two, remember, it's always a good time to own good charts. Have a great night.